I'm Charlotte McLeod with investingnews.com, and here today with me is Ben Finegold, director at Ocean Wall, where he runs uranium research. Thank you so much for joining me. Great to have you here.
No problem at all, Charlotte. Happy to be back.
Really good to be speaking with you, and it's been a little while since we had a chance to catch up. I apologize for not bringing you on sooner. I hadn't realized quite how long it could be, but it's been about a year. And I think where I usually begin these conversations is by asking you, where are we in the uranium cycle? And I thought since it's been a while, that was an appropriate place to start. So if we could just start with a brief, broad look at the sector and where you see it in the cycle.
Sure, it's definitely come on a lot in the last 12 months. I didn't think that I'd be sat here with everything that has happened, especially with the move in prices, and still be as optimistic around not only the underlying uranium price, but also associated equities as I am now. I think that we've definitely moved on since we last spoke. So if we maybe look backwards 12 months in everything that's happened, particularly production, that maybe a lack of the supply side response, and especially some of the larger producers not meeting targets, although, some have. So I would say that, if we were in the second innings 12 months ago, we're in third now. I think that the one thing that remains to sort of kick us onto those later stages is we're still waiting for sort of mainstream institutional capital to come into the sector. It's definitely played a more prominent role, but it's not it's not some of the levels that we think it can get to, and it's not at the levels that it certainly was back in the previous bull market in 2007. But we've moved on, not only in terms of obviously, just where we are in the thesis, but obviously in terms of prices as well. I think that when I first started to look at uranium back in sort of 2018-19, your baseline argument was the uranium price trades below the cost of production. So that made it quite a simple sort of supply demand, or you had quite a strong economic argument as to why uranium prices were going higher. With us at sort of $90 a pound plus today, the cost of production argument doesn't quite reign supreme as it perhaps did back then. But as I say, I'm surprised at sort of how bullish I remain, and we remain at Ocean Wall around prices, despite the fact that they're up 3, 4, 5 times since the lows of 2018. So a lot's changed, but a lot remains, I think, in this bull market for sure.
Okay, we'll go deeper into many of the topics that you brought up there, but I think it's really good just at the start. It helps me a lot to get that broad overview of what's going on. So where I thought we could go first is a little bit of recent news. So we've had the US ban on Russian uranium imports, and the market at this point has had some time to digest this news. And I've heard a lot of varying opinions on how important this is for the sector, especially given that the waivers will be available until the end of 2027. So starting there, I was going to ask you, how significant is this really?
It's incredibly significant. It's probably one of the more significant things that have happened since the invasion of Ukraine. And really, this is something that, it emerged straight after the invasion of Ukraine because, the US in particular was sanctioning pretty much every ancillary commodity coming out of Russia, oil, gas, metals, timber, pretty much every major commodity that's coming out of Russia had been sanctioned other than uranium. So even in the sort of weeks and months that followed February 2022, it was spoken about. And really, I think that we actually spoke about this last time, but, there was a lot of sort of maybe false headlines that were making their way into mainstream media that were perhaps not telling an accurate story as to, the actual sanctioning environment and the actual ban that was happening. Now, fast forward to a few weeks ago when, the ban was signed into law by President Biden. That's obviously been coming for a long time, as I've said, but ultimately for us at Ocean Wall, we maintained the belief that preemptive sanctions or retaliatory sanctions from Russia was really going to be the more significant event. Now, I'm not saying that the US ban is optics or just purely optics at all. I think that it really is. It's a very powerful mechanism by which the US can start to reinvest and incentivize domestic production and domestic investment into their own fuel cycle, whether it's mining U3O8 or conversion, enrichment, fabrication services. The one thing that I'm certain of is that it can't be bad for uranium prices. I think that the market's still juggling with the fact that, or sort of juggling with the extent to which it's going to impact different parts of the fuel cycle. I think ultimately, conversion and enrichment are going to be the more heavily impacted components of the fuel cycle as opposed to U3O8. But there's a lot of different things that can happen, and there's a lot of things that aren't quite clear yet. I'll talk about a few of them. The waiver process has attracted quite a lot of attention, and sort of whether this is going to be a pretty straightforward process. Now, there's a volume quota around, how much EUP could enter the US. And I don't think that's a massive restriction in terms of what can come in from Russia. But ultimately, it's going to be a question of, we put out a note to clients about a week before the news broke around a force majeure, the potential of a force majeure and a preemptive sanctions. And we saw that come out from 10X a few days ago, and sort of reading between the lines and also, reading some interesting stuff today that a lot of these US utilities have got 60 days to find financing for these contracts to get their waivers in hand and apply to 10X. So, as I say, it can't be bad to uranium prices. The extent to which it's going to have an impact on the price longer term is pretty clear. That the US utilities are going to have to find alternative sources of supply. But there is some, there's definitely some grey areas in it. So, what constitutes alternative supply? I think we've seen it in various other commodities as well. Can you take Russian EUP and put a different stamp on it and make sure that it still adds its way into the US? I'm sure that's possible. But it's going to be very, very hard to regulate. One thing that is for sure, though, is that the DOE has got a monster job on its hands, because it's going to be inundated with waiver requests from various US utilities. Pretty much all of whom are going to, I'm sure, be applying for waivers. Now, there are obviously exemptions for people that have been able to find alternative sources of supply, or those utilities that don't run the risk of closure, which are the two sort of criteria that the that the US government have laid out for this ban. But I think a lot remains to be seen, and we're going to find out a lot about the ban in the next couple of months, because we've now got a timeline on it. I think that Russia had pulled the US's bluff slightly by giving implementing this 60-day time window for the US utilities to basically get their act together, whether it's financing or getting their paperwork together for waivers. So, we'll see. But I think the underlying point is that it can't be bad for uranium prices.
Right. I think definitely we are on a countdown now with that ban. And I think you just briefly mentioned the possibility of a Russian counter ban. So I wondered if you could talk a little bit more about that and how much of a possibility that could be.
It's not a massive market for them. I mean, we're talking $1 billion, $2 billion a year. So in the context of, Russian oil, Russian gas, it's not a huge market. But it's 10% of 20% of US electricity. So it's 50% of their clean electricity. So if you wanted to stick it to the United States, this would be a great way to do it. Our original view on this was, what is the Russian incentive to keep shipping EUP to the US? Again, it's not a massive sort of cash cow for them. And if you did want to, put the US in a very, very awkward position, this would be an interesting way to do it. I don't want an Ocean Wall, and I know investors generally, they say you don't want to be profiting off the closure of nuclear power plants. That's not the thesis here. The thesis here is that we're in a long-term secular bull market for nuclear power, and the supply-demand dynamics of uranium don't add up to meet that demand. So, there's been a lot of bells and whistles that have surrounded this trade for the sort of 4 years, 5 years that I've been covering it. And this is sort of that next chapter. I think also it speaks to just how geopolitical uranium is a commodity. I've long held the belief that it is one of the most geopolitically weaponized commodities that you can have in the world. If any of your listeners have not read Mario Katusa's book, The Cold War, there's a chapter on the Putinization of uranium, which really talks about this weaponization and how, Russia might not have had the world's largest uranium-238 reserves, but they were, hell-bent on making sure that they became the dominant force in downstream conversion enrichment. So, there's a line written in that book which says there's no point having warehouses full of yellow cake that can't be feasibly used in nuclear power plants. And this is what Putin's, been able to do. He's been able to position Russia as an indispensable part of that supply chain. I wrote a report last summer around sort of Russia's unsanctionable position on the uranium market. I think that remains as true today as it did then. And I think we're starting to really see that play out now. We're starting to really see how unsanctionable they are. But back to your original question, the possibility of sanctions from Russia, I think it's very, very possible. I just don't see the incentive for them to keep sending this integral part of the US electricity sort of supply chain, energy grid. I don't see the incentive for them to keep doing that.
Very, very interesting. And continuing on down this path, I was reading one of Ocean Wall's recent notes where it talks about how contracting from US utilities was pretty subdued in Q1, possibly because they were waiting for some clarity on what was going on with Russia. So we do now have some clarity. So I'm wondering what you see coming from the US utilities in Q2, which of course we're in the midst of at the moment, and of course what that could mean for prices.
I think that everyone's been surprised, ourselves included, by the sort of subdued volumes in term contracting and, term prices. We'll find out the May term prices in a couple of days. But I think that, even really in a couple of weeks since the ban, we haven't seen a knee-jerk reaction to term prices that I thought we would, that I think a lot of other analysts thought that we would. I think that there's maybe a more important point here as to why this isn't happening. I think that it's to do with the naivety of fuel buyers. I think that if you look back at sort of 2006, 2007, fuel buyers could see there were the apex predator in the room, which was the hedge funds, really starting to gather momentum in terms of their procurement of uranium. And then you had a supply shock, which ultimately took the price, kicked it on into its late stages of that sort of $140 spike. I think fuel buyers at that time became slightly complacent. And, the example that we give is, traders or portfolio managers that didn't trade the 2008 crisis today don't sort of have that scar tissue that perhaps some of the fuel buyers don't have today. That maybe they weren't, they weren't around, or they weren't in those particular jobs during the previous spike sort of 15, 16 years ago. So, I think the fuel buyers perhaps waiting for prices to cool down a little bit. We've seen 300 to 500% moves across the fuel cycle, U308, UF6 slew. So maybe they're waiting for prices to calm down a little bit. I also think that, the argument that there was an outsized sort of contract in Q1 last year between Cameco and the Ukrainian utility, that doesn't hold as much weight now because we're in May, as you say, and we're well beyond halfway through the second quarter, and term volumes are subdued. Now it'll be interesting to see what that means for term prices. One thing that we are certainly aware of is that there's 4 or 5 US utilities who are short UF6, and that's obviously it's been clear for a long time that was one of the major choke points in the fuel cycle. So. I think that we're going to start to see a move much higher, both in terms of term volume and in terms of term prices. Fuel buyers have got the clarity that they need, particularly in the West now, on the US's stance on the future procurement of Russian uranium. So let's see what happens. It only takes one of those Cameco contracts like last year to for us to meet parity from this time last year. So I wouldn't be surprised if we saw one.
Right. And is that much higher in 2024, or is that a longer story? Because of course this is a story that will continue for some time.
I think the term volumes will, it's hard to say it now because we're at 27 million pounds 5 months into the year. I think term volumes will meet that same peak as last year and sort of get close to replacement rate again. I do think that's a multi-year theme. I think that we are set up for a multi-year replacement rate contracting cycle. And ultimately, that coupled with your outsized buyers, such as, financial buyers such as Sprott coming back into the market, and they're being a lot more active, and we should maybe talk about that as well. But, we put out a note a couple of months ago, just before the big move around the Scramble for uranium is sort of beginning now. And the Scramble for uranium, that doesn't mean there's an immediate panic. It means that we're starting to see various parties compete for pounds. And also it brings up this point around the supply side response. The supply side response for uranium, prices have gone from 17 to 90. You're going to start to see supply come into the market. I'm not talking about pounds out of the ground. I'm talking about traders that have held these positions for 4 or 5 years and who, they've met their price target. And again, goes back to this point that financials don't operate on the same time horizon that utilities do. These guys have got quarterly updates to provide investors. Utilities don't. Utilities need to secure power in 6, 10, 13, 15 years into the future. So again, you've got that inherent conflict between these different, and then you've got producers also coming into the market and buying as well. So financial producers, utilities, all competing for pounds at the same time. And I think pounds are starting to catch a bit more of a bid in the stock market. We were speaking to a very prominent trader, a uranium trader yesterday, around the liquidity of the market, and he's been impressed by the liquidity in the market. They're seeing proper volumes in the term market, and whereas before Christmas a couple of £100,000 could move price $5-10, it's not like that today, and I think that that's not necessarily a bad thing. We've never been, the thesis has never been contingent on a 2007-esque spike. The thesis has always been, let's see higher prices for longer, driven by this underlying fundamental belief in nuclear power and a supply landscape that doesn't quite match that build. So, I don't think, I think with improved liquidity, it decreases the chances of these spikes that we saw in 2007. Now, doesn't mean that I don't think that it's possible. I just think that we're starting to see maybe a slightly more mature uranium market than we've seen in previous years.
Right. And before we had turned the camera on, you were reminding me about the importance of differentiating between the term and spot market and prices. And I know you've gone into that a little bit here, but just want to check in with you and see if there's anything that you would add there that you want investors to be aware of.
I think so. Again, this is the question we get asked most, which is price targets and where's it going? The disparity between spot and term prices is starting to narrow. Now, that's obviously part to do with spot price coming off from 106 down to sort of mid 80s and now sat just above 90. And term prices have remained really robust, sort of $75, $80 a pound. So I think one thing's for sure is that we found a floor at about $85 a pound. So, for investors, again, whether you're going down the sequestration vehicle route of yellow cakes and Sprots, and I think there's very limited downside on those, but we maintain the belief there's an $85 floor in both in spot and around 75, 80 in term. So I think the pricing environment is incredibly supportive for investors at these levels. I think that we're going to go higher than the 106 this year for sure. I think that the elephant in the room is always going to be Kazakhstan, 43% of global supply. And I might sound like a broken record on this, but, we thought that was a pretty good place to start when we started our work on this space 5 years ago, considering just how dominant it is in terms of production, in terms of global production. We've got the Kazatomprom 2025 numbers coming out. I think they're going to flatline pretty much. You might see an incremental move up, but I don't think you're going to see an outsized increase in Kazakh production next year, maybe 5%. and even that, I'm not too sure where it comes from. It's sort of trying to remain balanced as possible. What's for sure is the 80 million pound target for 25 is not gonna happen. And then I guess the question then is, the extent of this sulfuric acid problem. We're on the record as saying that, the initial 2026 production estimate for the third sulfuric acid plant is going to be delayed. They delayed to 2027. I think that's going to go a bit later, maybe 28, maybe 29. I'll say I'm comfortable with 28. And then you've got to acidify the world's largest uranium mine, and then you've got to sell 3 years to Russia. A very long-winded way of saying the West is not going to see any of those pounds until 2030, 2032, maybe. So Kazatomprom numbers are always going to be a massive catalyst for moves in the spot price in particular. Cameco as well. Cameco, I think they massively impressed the market with the numbers they were able to produce last year. They're currently on target for this year, but the one thing that I would question with Cameco would be purchase number. I think the purchase number is going to be much higher, and that's more to do with Kazakhstan again, because I think they're going to get less out of their Inkai JV than they think, to the tune of a couple of £1 million maybe. So, I think, again, this goes back to the point around competing for powers in the market. I think we're going to see producers back in the market towards year end. I think there's a little bit of kicking the can down the road from all of them. For both of them, i.e. both utilities and producers kicking the can down the road. Let's see how late we can leave it. And I think that, it's all set up for a massive end to 2024 in terms of volume, in terms of prices.
Okay. Definitely, I think we're going in directions I was hoping to ask you about. So you've gone over, I think, a lot to do with what's happening with Kazatomprom. One other point that I wanted to ask you about is the company is reportedly even starting to look for assets outside of Kazakhstan. So I wondered if I could get your thoughts on that. Obviously, that would be a process that would probably take some time.
Yeah, I think there's a couple of possibilities here. The first is probably the least popular one with uranium bulls, which is they're looking to diversify outside of Kazakhstan. And that's possible. I think the second is that, they've got a lot of cash on that balance sheet, and they haven't really reinvested a lot of that cash in a way that I think some investors had hoped. So this is a way of them actually looking at spending some of that cash on their balance sheet. And then the third is that they don't have adequate confidence, or they don't have confidence that domestically they're going to be able to meet their production, their contractual obligations. Now, I think the most likely of the three is diversification outside of Kazakhstan, but it wouldn't surprise me if they're looking abroad, because they know that they promised a lot of material to a lot of different people. And, I'm again on the record saying that the West would be, Western contract, whether it's European or US contracts, probably be the first to go. I.e., I think that China and Russia have got priority on any pellets coming out of Kazakhstan for the next decade, really. You see pretty regular visits from Putin and from President Xi to Kazakhstan to see Tokayev. I mean, he's like one of the most popular sort of global leaders in the world at the moment. President Macron was over there as well recently. I think that the most likely answer is they're looking to diversify out there Kazakhstan, but given everything that we know around production issues and also these outsized contracts to the likes of China and Russia, it wouldn't surprise me if they had to start looking elsewhere to try and meet these goals. And also, Budenovskoye is meant to be online this year, and it's not going to be online next year. Someone was promised those pounds. It was Russia. As I understand it, Russia is sort of big to supplement those Budenovskoye pounds by taking a lot out of Niger, which, it is fairly new news to me, but a lot of those pounds from Niger are now ending up in Russian hands as well. So we've always spoken about China as sort of the demand outlier in the market. Russia's played that game as well. And again, I don't think that people are talking enough about the Middle East as an outsized buyer of uranium. or India either. I think they're both massive buyers, and also chop the US in there now with the Russian ban. It's just going to add fuel to the fire, and it's going to, again, it's just adding more and more participants to this sort of scramble for uranium that we think is going to accelerate over the next 6, 12, 18 months.
Right. And I think further on the note of supply, so we've talked about kind of what's going on with Kazatomprom and Chemical, and of course, everybody is watching them as the largest producers. But we do have various companies around the world now that prices are sustaining at higher levels, beginning to bring mines back online. So I'm interested to know what you're watching most closely when it comes to that.
The number one question that we get is why is this a different commodity story to anything else? So we need a lot of copper, and there's not enough copper. We need a lot of nickel, cobalt, these energy transition metals, lithium, and there's not enough lithium. You know, commodity stories, especially when it comes to the energy transition, they've all got quite a saturated tone or a saturated rhetoric about them, which is we need a lot and we don't have enough. So why is uranium different? And it is, to that point, it's because of the lack of a supply side response. It's so unique in that prices are up 5 times and we haven't really seen a supply side response. So, you know, last year, I think the global annual supply was about 14 million pounds added to global annual supply last year. And a lot of that is the low hanging fruit. This is mine expansion from incumbent mines, and also projects that have been in the pipeline, like Heinrich coming back online this year, and some of the US ISR mines that, you know, are starting to see ramp up a little bit this year. Take £1 million, for example. Let's say UEC going to produce maybe £1 million this year. That solves 1.8% of the deficit alone in 2023. We need 4, 5 Kazakh-sized mines to supplement this deficit. It's all good bringing online drips and drabs in the US, Peninsula, UR Energy, UEC, Encore. You can throw line of Hydric at it as well. It's not enough. It's not going to be enough. You know, we're looking at a couple of billion pounds of uncovered utility demand through 2040. I don't know where the pounds are going to come from. It's so rare to see that in commodity stories where you're just used to getting that knee-jerk supply side response. There's no uranium. There's no, you know, like there might be an oil. There's not these abundant strategic reserves that there are in oil. It's an incredibly fragile supply landscape. And again, I don't see where these pounds are going to come from. And now when you throw into the mix that the world's largest producer is having their own problems, again, you just sort of add layer on layer of this story. You know, one of the questions that I get is, everything that's happened in uranium, you know, why is the price not $500 a pound yet? And it's a good question because it feels like everything that could have happened has already happened. But the truth is that this supply deficit, people talk about, you know, uranium demand like it's just flatlined, that it's going to flatline at 180, 190, 200 million pounds. The reason we are in this trade is because we're fundamental believers in nuclear power. Nuclear power is going to grow. Uranium demand is going to grow. 5, 6, 7% compound annual growth rates. So you've got supply side as fragile. You've got the supply side as fragile as it is, and you've got demand really starting to kick into gear over the next decades. And then you can throw SMRs into that story. You can throw, again, you know, transition from underfeeding to overfeeding to that story. All these bells and whistles on top, and you start to realize that it is a unique commodity story. Versus anything else that you can buy, we think.
Well, it's interesting that you mentioned that idea that demand is going to flatline, because I find that it's a massive task just to keep track of all the different countries that are adding to their nuclear programs and things like that. And as you mentioned, of course, there's also SMRs in there. And conversations I've had around SMRs are kind of like, well, we know that this is coming, but we can't necessarily quantify exactly how much that is going to be yet. So what are your thoughts on SMRs? What can we start to know about the demand that they'll provide for uranium?
Sure. The SMR story is there is not a technological bottleneck yet. I was in Atlanta a couple of weeks ago at the Reuters SMR conference, 700 delegates, a lot of them on the development side, i.e. I took 25 odd meetings with SMR developers, people trying to build these reactors and get these projects, off paper designs and actually getting them built. The number one bottleneck that we spoke around was fuel. And this is, something that can really exacerbate the uranium supply side deficit, the supply demand deficit. Fuel is the number one bottleneck. There's plenty of designs that are going to work. The technology is there. The technology has worked for decades. It's now trying to find designs that make sense for customers and for investors. You can't just rely on the government to finance all these projects. Now, I think it's going to be a combination of both, but also the tin upload that went public a couple of weeks ago, they assumed the price of HALEU, ISA low enriched uranium, about 4 or 5 times the enrichment level of traditional nuclear power plants today. They assumed the price of HALEU would be around $7,000 a kilogram. Based off current SWU prices, uranium prices, conversion prices, we think it's closer to $35,000, $40,000 a kilogram, which means that these projects return negative IRRs. They're just not economically viable projects at all. Bill Gates's TerraPower delaying the Natrium reactor by 2 years because they could not find a feasible source of fuel outside of Russia. Now, there's various companies sort of, looking at addressing this supply deficit. I know that we're well documented in our work on Quantum Leap Energy, the ASB Isotope subsidiary. Silex is also trying the same thing. Silex is a $1 billion company now. So I think that, we need a supply side response in HALEU. The supply deficit that we forecast in HALEU is going to dwarf that of uranium halfway through the 2030s. So, I think that SMRs are 100% going to be a reality. I'm a believer that at COP28, 20 odd countries, including the UK, US, Japan, pledging to triple nuclear capacity, it's going to be really, really, really hard, if not impossible, to do that building traditional nuclear power plants. The UK is a case in point of that. We're really, really bad at building them. We've now bought the most expensive construction site on the planet, I believe. $34 billion for Sizewell. 34 billion pounds, for Sizewell. So we need a more scalable solution. We need to apply production line economics to nuclear power plant construction. And so, technology, it's going to have its say on this the same way that it always does. Data centers are also providing a completely new demand outlier. In terms of our energy requirements, these data centers have to come with their own power. They have to come with their own power options now. They can't just rely on the grid to supply the power that they need. Even just reading through NVIDIA's earnings last night, data centers have got a massive problem, and it's a power problem. So SMRs are the number one. They're pretty much the only option that these data centers have at their disposal to be able to solve this power problem. So you need a fuel response, and you need that's going to be the catalyst to getting these SMRs online.
Right. And I'm glad that you mentioned the data centers, because I had it on my mind to ask you about this conversation that seems to be developing around AI and possibly using nuclear power to serve energy needs there. And when I first started hearing this, I think it was around the beginning of the year, and I kind of dismissed it because I was sick of hearing about AI everywhere. But it sounds like it's a legitimate conversation to be having. So did you have any more thoughts you would add there?
I mean, I can speak to sort of my knowledge on the opportunity for nuclear in terms of data centers. These data centers require behind the meter power, and SMRs are just the best option for that. They need baseload power. They need power that's not reliant on the wind blowing and the sun shining. And, I think we're starting to see some crazy numbers around, 5 gigawatts of additional capacity for data centers in the US alone. And again, these data centers cannot just rely on the grid to support their energy needs. Now, one of the really interesting things that we've started to take a look at is actually, re-engineering these chips using a different type of silicon. 50% of the cost of these data centers is cooling. A company called Vertiv, for example, that supplies just heating solutions to the data centers. It's a $35 billion company last time I checked. That's because silicon-29, which, silicon-29 that's used on these chips, like the isotope used on these chips, actually has a negative spin around the nucleus, so it's a terrible conductor of heat. So these chips overheat. So we can find a more scalable solution via silicon-28, which, is supposedly meant to improve the conductivity of these chips thousands of fold. Again, ASTI is an interesting solution to that, as one of the only commercial producers of silicon-28 globally. That's a potential solution in terms of, being able to bring down the power requirements of these data centers, but ultimately they're going to need nuclear regardless. And so, again, it's going to, I think this was one of my main takeaways from the Atlanta conference was SMRs are becoming a necessity as opposed to, they're a must-have as opposed to a nice-to-have now. And with the numbers that we're seeing around energy requirements as a result of the data center and hyperscaler build-outs, there really is only one solution, because these companies also have to meet their clients' ESG goals. You can't just be running on coal and gas plants necessarily. You have to be meeting your ESG goals as well. So, how long can these things just be offset? We're going to need to build a lot more of them over the coming decades, and they're going to need to come with their own power solutions now. It's just not feasible to rely on domestic grids to be able to support them, not at the rate at which they're being built.
I think that helps me put that out into context. So thank you for going into that. And we've covered quite a bit of ground, I think, in terms of supply and demand, although it does feel like we've barely scratched the surface. But because I don't want to keep you too long, I want to start wrapping it up. And one point I want to make sure we go over is for investors. So it's good to go over all the dynamics in the market. But if we look over to the companies, where do you see the most opportunity at this point in the cycle?
So I get two questions every day from our clients, which is, have I missed the uranium thesis? And if I haven't, where does the value remain? I definitely don't believe that the uranium thesis is over. The uranium bull run is over. I think you've got a long way to go. In terms of investments, I still remain bullish on the spot price of uranium over the short, medium term. I think that we're going to have sustained prices of over $100 a pound for the next decade. So having some spot price exposure from your chosen sequester, whether it's yellow cake or spot, I think is still more than reasonable. I then think that a lot of the miners, developers, producers and developers, a lot of them are pretty full value. I think that you've got to be a lot more selective now. Again, also, having a look at the way in which geopolitics is going to reshape the financing for these companies. So, US uranium companies that are going to get support from this $3.5 billion as a result of the US ban on Russian uranium. Looking at US companies that have got large portfolios of uranium assets. It's very difficult to get exposure on downstream. Conversion, you can get a bit of exposure from Cameco, but, it's kind of a fraction of their bottom line. Enrichment, again, you've got Silex, but it's $1 billion company now on zero revenue. So it doesn't come without risk. ASTI I've spoken about as something that we find particularly interesting. Centrus is one that I've been watching every day since Russia's invasion of Ukraine. I don't understand how the long-term prospects for the company can be positive. Again, it's just 80% of revenues are reliant on Russia. So I don't see how long term it can be it can maintain its sort of its current valuation. But I think that you need to have a pretty balanced allocation across that delta Y spot price exposure. Be really selective in the development and production space. There's some names out there which have had an amazing run, but I think are pretty much at full value. And then you've got some interesting downstream plays, particularly on the enrichment side. But again, you've got to be selective.
Okay, I think that's always a great reminder. And just before I let you go, did you have any final thoughts that you would leave investors with? I always say that uranium investors are usually pretty astute and up with the market, but if there are any factors you think people may be overlooking at the moment, it would be great to go into those.
I think that we're sort of entering a new paradigm for the market, certainly in terms of geopolitics. In that, the market is bifurcating, feels like more and more every day. It was a bifurcated market 5 years ago, and it's being exacerbated week on week. And we're starting to see this real divide between the East and the West in terms of production, who's selling to who, in terms of power plant construction, who's willing to work where. So, we're always keeping our geopolitics, particularly from the largest players, Kazakhstan, China, Russia, the US. Again, I would urge anyone listening to this to read Mario Katusa's book, The Cold War, especially the chapter on the crystallization of uranium. It will give you a really, really comprehensive view of what it is that we're talking about here around the geopolitics of uranium. And it will also give you, I think, sufficient confidence to go out and to invest in this space, because you start to realize where the opportunities really lie, where the choke points are. But I think that, keeping your fingers on the pulse of geopolitics is important across commodities. But, as I said earlier, it's become so geopolitically weaponized, this commodity, this space, that I think it's a bit more of an outside player on that. But other than that, not much else to add. We publish our research on our website. Our larger reports are on our website at oceanwall.com. We give out our research for free. Some of our larger reports are free. So please feel free to go and check those out.
Okay, very good. Thank you so much for coming on to go over supply, demand, prices, companies in uranium. It was really great to have you.
No problem at all, Charlotte. Thanks for having me.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Ben Finegold with Ocean Wall. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.